Okay. Yeah, good afternoon, everyone. Welcome to our presentation about transitioning to a more sustainable future. My name is Eveline Maechler, and I'm Sustainable Investment Specialist at UBS Asset Management. Before we start, something about the organization. We do not have printouts today with us, but if you're interested in the presentation, you can leave us your business card, and we will send them to you via email afterwards. I'm looking forward to our half an hour together, in which I will walk you through the past, present, and future of energy, as well as our UBS Active Climate Aware equity strategy. In the end, we will also have time for some questions. So let's get started with this summary slide, in which you can see the connection first of net zero countries. So countries with net zero targets, as of March, 136 countries, covering 88% of emissions, have set net zero targets. Second, with the significant importance of investments in renewable and green tech. So we can see that until 2050, we will see a huge rise in renewable and green tech investments. And third, with the current situation, so the impact of the current geopolitical crisis on the EU carbon prices. So here you can see a huge decline. So the European carbon prices have been negatively affected by the current situation in Eastern Europe, with expectations of slower economic growth. This then led to lower growth expectation, lower carbon emissions, and then this resulted in this decline. So, however, many countries have already set net zero targets, and that's why we see that this will not change. And that's why we see also that it's important to secure these reductions in emissions and promote a low carbon transition. We expect carbon prices to recover beyond the shorter-term geopolitical disruptions. We think that investing in green tech, clean air and carbon reductions, and also carbon trading strategies and such as commodities is a realistic, diversified way to navigate the trend towards net zero. So, in addition, the war in the Ukraine has added urgency to a long-lasting energy dilemma. And it's the trade-off between security of supply, prices, and carbon emissions. Then we are witnessing a relentless rise of energy demand. It's expected that until 2050, the energy demand will grow by 50% due to the world's population expands and living standards will improve. At the same time, nations are trying to wean themselves off the world's dominant energy source, fossil fuels, which still accounts for more than 80% of total consumptions. This desire to decarbonize with the low prices has led to years of underinvestments in oil and gas extraction, which is down about 60% since 2014. The fast rise in renewable sources, which account for just 6% of global energy consumption, is not enough to compensate for this decline yet. So reducing the reliance on Russia makes this problem more acute. Russia belongs to the largest natural oil and gas exporter as well as producer. So the future of European development could depend also on Russia's energy supply to Europe. So how is this energy dilemma likely to be resolved? And what does it mean for investors? Our approach is to invest in the past, present, and future of energy. So we can see in the past, we relied on traditional fossil fuels. However, the transition to green energy will not happen overnight, and we estimate it will take more than 20 years to fully reduce our dependency on fossil fuels. Even assuming renewable capacity continues to grow at the annual growth rate of 12%, as it has averaged over the past 10 years. So investors can direct funds towards sustainable leaders within fossil fuel, so companies which are ready to adapt their business models and or already adapted their business models towards renewable energy. Then in the present, we see that investors should invest in the present generation of renewable technologies such as wind and solar, along with battery and grid systems. They are needed to enable these sources to be stored and delivered to customers. This disruption to natural gas and oil from Russia is likely to provide further incentive to these kind of renewable energy sources because they can be domestically produced and there is no dependency. So while renewables have the drawback of intermittency, since the wind is not always blowing and the sun is not always shining, advances in storage are needed to overcome this issue. And that's why we also see that it's very important to invest in the energy efficiency technologies simultaneously to reduce reliance on outside supplies, fuel bills, and carbon emissions. We see plenty of investment opportunities also in this field. And while the war in the Ukraine will increase the temptation to fall back to coal, the dirtiest fossil fuel, we don't think that this will happen because companies and countries have set their net zero targets and will continue focus on them. Now we are turning to the future of energy, so it's also that we think we need to keep a close eye on innovation to invest in innovations that outstrip current technologies and have the potential to provide green solutions beyond like power generation. These include, for example, green hydrogen, carbon capture and storage, as well as biofuels. So we believe investors can play a role in overcoming the energy challenges that have been intensified by the Russian invasion. So we believe that investors can invest in fossil fuel companies which are ready to adapt their business models or already adapted their business models towards renewables, in renewable innovators and pioneers of the next energy generation. So you can also kind of invest bundled within a fund in this. And this is our UBS Active Climate Aware equity strategy. This UBS Active Climate Aware strategy we developed already in 2017 together with a UK pension fund. At that time, it was a rule-based strategy, also called enhanced indexing or smart indexing strategy. We developed the concept of climate aware further, and in June 2020, we launched an actively managed equity strategy as well as a fixed income strategy. Today, I will introduce you the UBS Active Climate Aware equity strategy. So, why climate awareness is important? First of all, the climate challenge. Current policy suggests that average temperature will rise to 3 degrees until the end of the century. Then we see also that not the portfolio will benefit, also the planet will benefit. And then it's like the new normal. Regulatory changes and increased awareness have made climate investing essential for investors. So we see that aligning to a 2-degree warming is very important and also attractive, because when we do not action today, the cost of inaction outweigh by far the cost. And also when we do not limit the negative impacts from climate change exceeding a 2.5 degree of warming, the consequences are very substantial and far in excess of impacts with limiting warming to 1.5 degree or well below 2 degrees. So the portfolio benefits is also that we can see risk management and strong tailwinds support a climate-aware approach. So there are climate-aware investment opportunities. A 2-degree scenario leads to enhanced projected returns than a 3 or 4-degree scenario for nearly all asset classes, regions, and timeframes. Then carbon adaptation can generate many significant investment opportunities, such as renewable energies. So then it's also the new normal, as already said, it's like the regulatory changes such as TCFD or the Paris Agreement are pushing climate to the forefront. trending popularity also as flows for climate finance increased by 25% in a single period between, for example, 2015 and 2018. And we also saw that in the last years. So what is our solution to address this opportunity? Our UBS Active Climate Aware Equity Fund. It's an actively managed strategy which consists of 55 stocks. It's a best ideas concentration portfolio, and to select the stocks we use a holistic approach. We focus on the leaders within the 3 categories: climate mitigation, adaptation, and transition. In addition, this strategy can benefit from our dedicated climate engagement program, which is supported by the Sustainable Investments research team, and also the portfolio management team also manage several other sustainable investment strategies. So, what would a low carbon economy look like, and what are climate adaptation companies? So climate adaptation companies are companies which provide products and services to other companies or customers, which enable them to reduce their CO2 footprint and to kind of enable them to be part of a low carbon future. For example, industrials, technology, or renewable energy companies are providing essential technologies to shift businesses and customer practices. Then we have climate mitigation companies. So these are companies which are able or like leaders in addressing climate risks within their own operations. So because here we see it's not only important to look at the heavy polluters, we also look at other sectors such as banks or retailers. So here we look at banks which are like support green projects, or we also think that it's important, for example, in the retail sector, that they are able to manage overconsumption and waste. Then in the climate transition pillar, we look at companies in carbon-heavy industries that are transforming their existing business models. And especially within the carbon transition pillar, we engage with the companies to also support them and guide them towards like to be aligned, for example, with the Task Force of Climate-Related Financial Disclosure Framework. So what are the metrics we look at? We use a multidimensional set of metrics, so we look at quantitative and qualitative factors to identify climate leaders in the investable universe. So the first pillar is the climate adaptation pillar. In this pillar, we look at companies with innovative technologies. So first we look at the thematic universe. Here we look at companies if they generate like revenues or have R&D investments across like environmental themes. Then we also look at renewable energy companies to capture the substitution of energy sources by clean energy. Then in the climate mitigation pillar, we look at the CO2 of the carbon profile and climate commitments. So what is the carbon footprint of the company? What is the carbon intensity of the company? But we also look at the E-score and the climate commitments. So is there a climate, for example, climate change policy in place? Then we also have the climate transition pillar. So it's very important that the first two, the climate adaptation and climate mitigation pillar, are like based on historical data. Whereas now the third pillar, the climate transition pillar, also takes into account a forward-looking component. So here we look, for example, at the 2-degree glide path probability. This is a quantitative model developed by UBS Asset Management, and in there we compare the company's carbon footprint trend with the required emissions reduction implied by a 2-degree scenario. And there we look until how the company is doing compared to the peer until 2030. And if they are better than its peers or like the industry, then of course they are attractive. If they do worse or like below industry or below peers, then they of course they are not attractive. And then we also look at create our own low carbon commitment score. This is based on 5 qualitative disclosure and like qualitative related indicators, such as reported carbon emissions. Does the company report the carbon emissions? Are there emission reduction objectives or policies? Now, Here you can see it's a step-by-step process, like portfolio construction. So first we look at the investable universe. Our benchmark is the MSCI All Country World. And then we identify for each pillar the leaders. So we identify in the MSCI All Country World the leaders in climate adaptation pillar, in the climate mitigation pillar, as well as the climate transition pillar. Then we are around 1,000 stocks. On top, we add an integrated financial analysis. So we look at eligible stocks that have an attractive valuation and also an overall sustainability profile. This leads us to around 250 stocks. And then based on, out of these 250 stocks, we create our portfolio, which is at the moment of around 56 stocks. So it's a very highly concentrated active portfolio. Here you can see our climate change engagement program. So the goal of our thematic climate engagement program is collaborating with companies to support the transition. And our climate engagement objectives, so we set objectives with the companies, are all aligned with the Task Force on Climate-Related Financial Framework, on risk management, metrics and targets, strategy and governance. We already completed our first phase of climate engagement. Our first climate engagement phase went from March 2018 until March 2021. With this, during this climate engagement program, we engaged with 45 companies. And we saw, especially in the oil and gas sector, as well as in the utility sector. We engaged with all the companies in the climate transition bucket, like pillar, and with selected companies in the climate adaptation pillar. This, we also had a look at, hey, what did we achieve during our dialogues with the companies? And in the end, we decided to exclude 5 companies from all our sustainable focus actively managed strategies, as well as rule-based climate-aware strategies. Due to these companies showed unsatisfactory progress, especially in climate topics. Then last year, we kicked off our second phase of climate engagement. And we now decided not to focus only on the oil and gas and utility sector. So now we also focus on other other sectors which have a climate impact. So also, for example, on transportation. And at the moment, we engage with 46 companies, and we took over 22 companies from our first phase. What is also new, we look at leveraging our overall exposure. So we don't look only at, hey, at our equity exposure, so we also look at our fixed income exposure and combine it, that we are really also can then show that we can really kind of engage with the companies. We have a high financial exposure. That we also can really have an impact. And that's what we can see in this case study. So this is a case study of a climate engagement dialogue. So we saw that there was an issue with this company because the company had a lack of commitment to transition away from fossil fuels towards a low carbon business strategy. And so then we decided to engage with this company as part of Climate Action 100 Plus investor coalition, but we also engaged bilaterally. And then we haven't seen any improvements, and that's why we then also decided to vote against the chair, and as well, it's the same, the CEO, chair and CEO, to reflecting this lack of sufficient progress in climate change management. And then after these 3 years, then we had a look at the outcomes of this dialogue, and then we saw that the greenhouse gas reduction targets were limited in scope and continued to be weaker than, for example, of other peers. This led then to the exclusion of this company last September in all our sustainable, focused and rule-based climate-aware strategies. We continue to engage with this company, and at one point maybe we will also consider to invest in this company again, but at the moment we still exclude it based on its limited climate efforts. Here we can see the fund performance. The fund outperformed the benchmark since inception by 1.5 to 9%. Before like the Q1, the outperformance was way higher. As of December, it was around 8-10%. We see this underperformance year to date due to also the exclusions we have in place. We exclude all fossil fuels within this fund. So these are the companies which are not excluded in the MSCI All Country World. And so we also see that due to the current situation, these were this sector was also kind of went very well. So here we can also see that we kind of do not profit from these exclusions. But we exclude all fossil fuel companies. But we don't think this is a long-term trend. So we think that the long-term trend is clearly in the renewable sector, and that the performance will come back as we performed like in 2020 and 2021. So we think it will come back. Yeah, especially when you think of all the net zero targets companies and countries have. And then we also can see the CO2 profile. So here, the lower, the better. Here we can see on the left side the carbon footprint. So the Active Climate Aware has a very lower carbon footprint of around 64% lower than the benchmark. And also the weighted average carbon intensity is way lower with around 43%. Yeah, so it's very good. And we can see that we really kind of also focus on these key measures. These are like considered especially in the climate mitigation pillar. Here we can see the top 10 companies by weight on the left side, the sector allocation as the country allocation, as well as the climate categories. So here we more or less, the sector allocation as well as the country allocation is more or less the same as the benchmark, the MSCI All Country World, because we really aim to kind of reduce the risk to stock-specific risks. We can see the highest active weight in the sector in industrials. So why industrials? Because industrials provide solution to other companies to a low carbon future. So they enable other companies to reduce their own CO2 profile. That's why we have the highest active weight in the sector. And this you can also then see that this is the highest climate category with climate adaptation, which accounts for around 59%. Now you are maybe wondering why the climate transition bucket is only 2%. This had to do with like last year, we thought that they were too expensive. They were overvalued, and that's why we decided to sell some stocks within this bucket, like pillar, last year. And then also, like for you, what stocks are in the Active Climate Aware Fund? We brought 3 examples. So one example for a climate adaptation company would be Montrose Environmental Group. So this is a leading provider of synthetic chemical solution treatment. So they take out like the synthetic chemicals, or for example, take them out in water. So that's why, and we see a lot of tailwind, for example, in this business from regulations. And then another example for like a climate mitigation company would be Société Générale. So this Société Générale contributes to climate mitigation through low carbon emissions and low carbon intensity. Then Iberdrola. So Iberdrola is an example for a climate transition company. It's a traditional electricity supplier that is at the forefront of the energy transition as the world's largest producer of wind energy. And the company has invested significantly in renewable energy since 2018. Now, why invest in the UBS Active Climate Aware? So, like first, you can benefit, or you can contribute kind of to challenges of climate change and benefit from market opportunities. So regulatory changes and growing climate awareness make climate-friendly investment essential for investors. In 2021 alone, around $37 billion was raised in the green sector. And also net zero pledges have accelerated. In addition, like since last September, we got awarded by the Austrian eco-label called Österreichisches Umweltzeichen. So this is an external recognition which helps like provides guidance for investors who want to invest in like economic according to ecological and social ethical criteria. So that's why, for example, we also decided to really exclude all fossil fuel companies to also be able to apply for this certificate. And that's why we got then awarded and assessed by an independent assessor. And also, it's a global concentrated portfolio of best ideas with around 55, 56 stocks, and it's well diversified across sectors and countries. So the risks are then mostly only stock specific. Yeah, thank you for your attention, and now we have time for some questions. If you have any questions.